Now, those were exceptionally kind words. You know, when I hear these introductions, I always look behind me and wonder who they're talking about. Before I start, what I'd really like to do, and this is not only on my own urging, my wife insists that I do it also, and that is that I would like to raise a toast to the godfather of GATA, who isn't here with us this weekend, Frank Veneroso, because so much of the work that's, we've based a lot of this stuff on has been done by Frank, and I mean, the guy is amazing. And I've got his sort of, the new guy coming behind him that's working with Eric and I, Andrew Hepburn. He's the new Frank Venerosa, but we haven't let him out of the box yet. To Frank, though, yeah, he's been fantastic. Get you up a little higher? Thank you. So it is my distinct pleasure and honor to address this august gathering. You know, as a Canadian citizen, I would like to take this opportunity to welcome the many attendees from around the globe who have come to the Canadian North. I mean, all of us in the gold fraternity are deeply impressed with the effort that's been expended to sort of travel from far-flung places around the globe to hear the truth about gold. And one thing about GATA, you will hear the truth about gold. So I would also like to both thank and congratulate GATA for their efforts in putting on this outstanding conference. I mean, I can't tell you how impressed I've been with Dawson City so far. And for their tireless pursuit of the truth in a very opaque gold world. Bill Murphy, Chris Powell, and their relentless GATA army all deserve tremendous thanks from anybody who wants a free and fair gold market. I only wish that more of my fellow Bay Streeters had taken the time to make the journey to Dawson City. Mining is an important industry in Canada, and gold shares are very big business in the Toronto Stock Exchange. So I find the lack of interest in this subject in Canada's major financial centre to be very disturbing. However, I don't think it's terribly surprising. Perhaps the only similarity between the financial establishment in Canada and this conference is that they both sold out. Having said that, I do have to tip my cap to our adversaries, the Western central banks and their bullion bank allies, who so far have done a masterful job in suppressing the gold price and hoodwinking the public. They are formidable, but albeit terribly misguided. But one cannot dispute their efficacy to date. Despite financial and geopolitical conditions which couldn't be much better for gold, and against a backdrop of a massive supply-demand imbalance, exacerbated by falling mine production, they have succeeded in fostering amazing disinterest in gold. Recently, the sentiment towards gold can only be construed as terrible. To explain this conundrum, we only have to consider our colleague Bill Murphy's oft-repeated phrase, price action makes market commentary. By placing an effective stranglehold on gold, virtually never allowing it to rise by more than $6 in a single COMEX session, capping it very aggressively when it reaches critical price points, and trashing it when market opportunities permit, the anti-gold cartel has almost obliterated the Western investing public's interest in the yellow metal. When my brilliant young colleague Andrew Hepburn, and I cannot tell you how bright this kid is and how he is going to be something before this is all over. But when he and I wrote this opus, and he wrote most of it, Not Free, Not Fair, The Long-Term Manipulation of the Gold Price, a copy of which I think you all received today in your handout, we were very hopeful that the revelations contained in the report would at the very least restrain the anti-gold cartel. How wrong we were. They have become infinitely more blatant. Apparently this Dracula is willing to withstand more light than we first thought. What I find fascinating is that despite this recurrent market action, this obvious manipulation, most people do not even want to consider the possibility that the gold price is being managed. Even worse, many of gold's alleged friends, who profess to be very bullish long-term, feel obligated in the near term to show how clever they are by forecasting lower gold prices, thus aiding and abetting the cartel in its activities. Technical analysts, in my opinion, are amongst the worst offenders. I'll cite one, Ian McAvity, who hopefully won't be offended because he's an old friend, a fellow trustee in the Central Gold Trust, and a very much a long-term believer in gold. McAvity writes an excellent investment letter entitled Deliberations. In mid-July, while addressing the subject of the next upcycle in gold, so this was just over a month ago, he wrote, "I remain concerned that each of the bull runs in gold since 1971 totaled 35 to 41 months from low to peak. The last run to December 04 ran 44 months. In that context, I worry about the course of a cyclical downturn may take, particularly when troubled by the fact that gold shares peaked out a year ago or a year prior at their December 03 peak. The failure of shares to match the higher high of gold in December 04 has bearish implications in this cyclical context." He then went on to say that, "My view is, yes, the 2001-04 bull phase likely broke the 20-year secular downtrend in the U.S. gold price, but ran ahead of itself and faces a down cycle to digest the gain from 250 to 450. If I'm right in secular trend, the decline should not give back more than half the prior run, which leads to my long-held target of 375, possibly 360. I still fear a dollar rebound that surprises on the upside may rattle the gold bulls below 410 and contribute to the slide to 375. Then I could get bullish on gold for 2006, 2007. Now, what a crock that is. You know, this kills me to say it because McAvity's a great guy. But it is nothing short of ridiculous and probably best reflects the abject failure of technical analysis in a clearly rigged market. What goes unremarked by Ian is the obvious fact that gold should never have fallen as far as it did in the first place. An orgy of short selling facilitated by enormous central bank gold lending in conjunction with the pathetic British auctions drove gold down to nearly $250 an ounce. This created a situation that resulted in the first Washington Agreement, which has been mentioned many times earlier today, which was announced in September of '99. 15 European central banks agreed to limit their selling and leasing of gold, thereby igniting a massive short squeeze. I remember that morning when I came into the office. God, it was a highlight. Gold catapulted to $340 before the official sector re-entered the fray. A Dow Jones article at the time began with the following sentence: "Central banks are selling gold in order to prevent a further sharp rise in prices from causing a major financial crisis," according to Ted Arnold, analyst at Prudential Beige. It continued, "Many funds and banks sustained heavy losses over the past 2 weeks as gold surged after 15 European central banks stunned the market by saying they would cap sales of gold for the next 5 years. If gold prices continue to rise sharply, they could cause major losses at U.S. and European investment and bullion banks and cause a domino effect that could lead to a major financial crisis," said Ted Arnold. And Arnold was always a bear, so it was interesting that he said this. So to avoid the unpleasant journey into the abyss, the central banks then systematically drove gold down to an effective double bottom at 260 just near the end of 2000. So what I would say is that without aggressive central bank lending in the first place, gold probably would never have penetrated 350 on the downside. And most assuredly, had it not been for the British gold sales and the post-Washington Agreement central bank machinations, the gold price should never have been driven below 300 once again. So in my mind, the idea that gold has to correct this move from 250 to 450 doesn't fly from the outset. The subsequent aggressive suppression of the gold price rise all the way up, in my opinion, doesn't call for a correction at this point. It cries out for gold to seek out its rightful value which based on several metrics I use is hundreds of dollars per ounce higher than the current price. Now, this is the one metric that appeals to my partner Eric Sprott and I, and that is the historical ratio of the price of an ounce of gold in relation to that of a barrel of oil. In a relationship that has been in effect since the gold price was unleashed in 1971, a price of an ounce of gold has traded on average in the sort of succeeding 34 years at an average of 15 times at the price of a barrel of oil. Today, the ratio is 7 to 1, and if the historic relationship were in effect, the current price for gold would be roughly $800 to $900. Now, why is this relationship so strikingly broken down? Because the supply-demand situation for oil is so bullish that gold can't keep up? Well, I guess that's a possible reason, but I don't think so. I mean, the World Gold Council reported that in the first quarter, physical demand for gold was up in the neighborhood of 25%, while mine supply was down overall and down sharply in many key gold mining countries. In view of this wide gap between demand and mine supply in the first quarter and the existing gap coming into the first quarter, you might be shocked to hear that the gold price did absolutely nothing in the first quarter. This becomes less shocking, however, when you learn that official gold sales, the gold sector sales rose about 18% from the fourth to the first quarter, and much along the lines of what Reg Howe had to say earlier today, we await what derivative activity took place to keep the gold price in its box. Now, with respect to my friend McAvity's view that gold share weakness presages lower gold prices going forward, it must be pointed out that the extreme weakness in the U.S. dollar in 2004 vis-a-vis other currencies made gold mining in countries other than the U.S., i.e. most of it, dramatically less profitable. But perhaps even more damaging has been the huge rise in costs of everything employed in gold mining. I mean, you name it, energy, steel, explosives, I could go on, which they all sharply outran the modest price rise in gold. And as a result, the profitability in gold mining has been crushed. I honestly don't believe that, with the odd exception, that the economics of gold mining are any better today in most constituencies than they were when the gold price was in the mid-200s, like 250, 260. So the fact that the gold stocks did not sort of exceed their late 2003 peaks in 2004 like gold did should not be the least bit surprising given the fundamentals around the gold stocks. And in my opinion, it certainly doesn't suggest the inevitability of lower gold prices. To the contrary, it virtually demands higher gold prices, or the gold mining industry is going to continue to implode. Now, I cannot tell you, in all honesty, how irritating it is to hear my friend McAvity's views spoken as a longer-term gold bull, when we have to continue to listen to the rubbish being dealt out by the likes of Kamal Nakvi of Barclays. We can only be thankful that John Brimelow's good friend Andy Smith has left Mitsui, so we don't have to be subject to his propaganda any longer. Now, whereas McAvity's views are an honest, albeit misguided group of views, seen purely through the eyes of a technical analyst, Nakvi is clearly a hired gun working for Barclays, a gold uber bear closely aligned with the Bank of England. While commenting recently that gold's rally in June wasn't sustainable because the market is too small to be a viable alternative to major currencies, he dealt in some serious misinformation. Nakvi called bullion supplies resilient, which is certainly not reflected in the experience of Swiss refiners who are finding it increasingly difficult to access metal. He stated that inflation is well contained, which is the standard nonsense emanating from Greenspan and the central banking crowd, and I'll get into that in a little more detail later. And finally, the Barclays analyst contended that gold inventory levels are massive and that central banks remain major net sellers. In fact, central bankers, in my opinion, are scrambling to supply enough gold to meet physical demand at these price levels. And the suggestion that their inventory levels are massive is perhaps the most insidious lie currently being perpetrated by the anti-gold gang. The key to the gold market, and John Brimelow dealt, I thought, very well with this today. I really enjoyed his talk. The key to in my mind is the fact that a considerable amount of the central bank gold has already been mobilized over the past 10 years in the carry trade business and the ongoing price suppression scheme. And since it cannot be sold a second time, this fact will become the major determinant in the direction of gold prices in the not too distant future. These guys are running out. Now, what I find most reprehensible about this whole charade is that we have seen this act before, and it failed spectacularly in its first run in the late 60s and early 70s. At least the London Gold Pool, which was in effect at that time, was a considerably more open attempt to hold the gold price in the neighborhood of $35 and maintain the fiction that the US dollar was as good as gold. However, it was overcome by the reality of a large U.S. budget deficit driven by the attempts to conduct the Vietnam War while financing the Great Society, an explosion in oil prices, which ultimately took the price from under $3 to $40, and rampant inflation throughout the system. The value of paper currency came into question, and gold rose from $35 to roughly $800 per ounce in less than a decade. It wasn't corralled until Paul Volcker took over the reins of the U.S. Fed and, using draconian methods, squeezed the inflation out of the U.S. system for a very short period of time. Now here we are, 25 years after the previous peak, and they're at it again, aggressively suppressing the gold price in an attempt to protect the world's totally fiat monetary system. I'm not sure what is more pathetic at this point: the renewed attempt by the powers to be to control the gold price in the face of their previous failure, or the investing public's blithe disregard of history and acceptance of the current status quo. In any case, the fundamentals for the U.S. dollar, and by extension all paper currencies, are ghastly. And the anti-gold cartel's efforts this time are fated to meet exactly the same end as they did in the early 70s. Except this time there will be no Paul Volcker or Volcker clone eventually to eventually defend the sanctity of the monetary system. To the contrary, I think the future will see Ben Bernanke as Greenspan's replacement at the helm of the U.S. Fed. Yes, that very same Ben Bernanke, now cutting his teeth as Bush's chairman of the Council of Economic Advisors, who in his role as Fed governor 3 years ago stated that to stave off deflation, the Fed had access to a printing press and would use it if conditions warranted. He also prattled on about using helicopter money and what have you. But nevertheless, in view of these inflammatory statements, I really think that the current gold suppression scheme looks like an act of desperation, which will soon be overrun. So the question is, how has it come to this? There are varying thoughts on this, but after a lengthy period of gradual financial deterioration that got underway around the time of the onset of the Vietnam War, there's a few of us in the room, I think, that remember that era. But I believe that America finally embarked on the path of no return in late 1996. Everybody sort of has a point in time when they realized that there was no turning back. But I think this is a pretty good example of what happened. On the morning of December the 3rd, 1996, having watched the Dow surge a robust 27% that year, Fed Chairman Alan Greenspan hosted a private meeting that became a more personalized version of the now canceled debate show Crossfire. On one side of the debate was Abby Joseph Cohen, the Goldman Sachs strategist who was widely regarded as the poster girl for the unfettered bull market. She delivered a list of reasons to Greenspan, explaining why underlying economic changes justified such lofty prices in the stock market. Arrayed against her were two Ivy League economists, Yale's Robert Shiller, who subsequently wrote the book Irrational Exuberance, and Harvard's Joseph Campbell. They painted a much gloomier picture and illustrated their message in 10 pages of handouts showing trends going back as far as 1872. They argued that markets would do well to tread water and could well crash. Now, armed with this information, Greenspan made his now infamous speech 2 days later at the Washington Hilton, which he uttered the words that are destined to go down in history when this era is more critically examined in the future. He stated, "How do we know when irrational exuberance has unduly escalated asset values? And how do we factor that assessment into monetary policy?" The immediate reaction to his musings was stock market weakness, but it was short-lived. Equities soon resumed their march higher, and Greenspan's opportunity to remove the punch bowl when the U.S. could conceivably had undergone a garden variety stock market pullback and a mild containable recession, it passed. At that point, I believe, we were launched on a path from which there was no turning back for either the U.S. economy or its financial system. Not long afterwards, Greenspan became a cheerleader for and a facilitator of the so-called new paradigm, which he justified on the basis of ostensibly huge productivity gains. This led to outrageous stock valuations, which culminated in a historic technology bubble and corporate greed that knew absolutely no bounds. They're still prosecuting people for that one. Greenspan rejected all talk of bubbles by observing that you couldn't ascertain that you're in fact in a bubble until it ended, an observation that I viewed then and still view now as ludicrous, coming from a man of his intellect and experience. What motivated Greenspan's volte-face on the subject of irrational exuberance in the stock market when his original instincts were essentially correct? It is widely believed he succumbed to the pressures of both Wall Street and Congress, neither of whom wanted to see the boom stalled. Perhaps the flavor in Washington at the time was best summed up by a comment that Robert Rubin, the Secretary of the Treasury at the time, made at a Washington think tank in 2000, not long after leaving government service. Responding to a question about current account deficits and whether he worried about them in his tenure as Treasury Secretary, Rubin cavalierly replied, "We figured the good times were rolling, let them roll." When the questioner persisted and asked, was he sorry, Rubin stated, "No, am I sorry? Mainly because of that nasty old Fed that kept being a nuisance." So Robert Rubin, who has moved seamlessly between Washington and Wall Street, probably represents the perfect example of the mindset at that time. And I suspect Greenspan found it much easier to go along with the crowd than to resist. Now, as an aside, I must admit that I now find it the height of hubris that the very same Robert Rubin is bemoaning the current state of the world when he was unquestionably one of its architects. So when the inevitable tech bubble burst, the fallout had, really serious economic and financial ramifications. Greenspan was forced to respond in the same manner that he had done when faced with a crisis beginning at the outset when he had the stock market crash in '87. He threw money at it and flooded the system with liquidity. This time he didn't hold back. His actions no doubt reflected the seriousness of the situation, and I don't think there was any question that after the bubble burst there was tremendous concern, so I can understand his motivation. And he drove the Fed fund rates down to 1% and held it at that level long after it became inappropriate to do so. At that point, Greenspan became what Stephen Roach, Morgan Stanley's irrepressible strategist, termed a serial bubble blower. As a result, I believe the U.S. has now launched irreversibly on a course that will lead to accelerating inflation, culminating in either hyperinflation or a vicious debt implosion, or conceivably both. I am a very big believer in the Austrian School of Economics, which has been mentioned today more than once, which puts huge emphasis on credit cycles as the key economic determinant. And I believe we are currently launched on the mother of all credit cycles. I feel at this stage very few investors have arrived at this conclusion. I would rule out a lot of the people in this room, but trust me, a lot of the other people I talk to around the financial sphere, they just think we're basically going through another typical economic cycle. However, I think that when reality hits home and the true state of the world's major currencies become apparent, gold will finally come into its own. And I believe, thank God, that time is getting very close. Now, as much as it pains me to say this, being a real enthusiast for gold, I still think that gold is only a minor player at this juncture in a much bigger picture. But because it is an important barometer of financial health, the so-called canary in the coal mine, it must be controlled to maintain the fiction that the economy is strong, inflation is well contained, and all is well in the world of paper money. Given that reality is so wildly divergent from these myths, government officials will do their best to obscure the gravity of the current economic and financial picture. The authorities correctly recognize that any inkling of accelerating inflation is anathema because it would lead to rising interest rates in America, which would unleash all sorts of chaos. However, their monetary policy, in my opinion, ensures just such an outcome. I'm sure everybody in this audience is fully aware of the housing bubble in the United States. Even Greenspan himself is inching towards acknowledging it, and this man does not like dealing with the subject of bubbles. However, I am not sure everyone fully appreciates what the bursting of this bubble implies. I believe it will make the end of the tech bubble look like child's play. Indeed, The Economist magazine recently stated that the housing market globally, which the United States epitomizes, looks like the biggest bubble in history. Americans have been sustaining their consumption by extracting equity from their homes. Their confidence is sustained by a feeling of well-being as their house prices rise. And not surprisingly, the sector's overall impact on employment cannot be overstated. Since 2001, nearly 50% of all jobs in the United States have been created were in some way related to the real estate market. Now, job creation in the United States, as you all know, has been one of the Achilles heels of this recovery. Without the contribution from the housing boom, it would have been an unmitigated disaster. So rising interest rates triggered by the onset of inflation cannot be tolerated, and everything must be spun to hide the truth. In the short run, all this acts as a great detriment to gold. To maintain the lie that inflation is well contained and thus allow interest rates to remain low, it is also imperative that gold be well contained. So why should we be surprised that gold is aggressively managed when the consumer price index is so egregiously distorted and thus understated in the U.S.? Not to bore you, because this is fairly arcane stuff, because I'm sure many of you are aware of this fraud, but it is worth enumerating the systematic abuse that's going on in compiling the CPI in the United States. It all begins with the use of hedonic accounting, that arcane subject which adjusts prices downward to reflect quality improvements. Whatever merit this undertaking may have is overridden by the subjectivity of the adjustments, particularly with respect to the large adjustment in the prices of computers and autos. But it doesn't stop there. It has been introduced into health care and textbooks. This stuff, give me a break. This is ridiculous. And it facilitates considerable understatement of the CPI. Now, equally as bad is the treatment of shelter costs, which comprise nearly 23% of the total CPI. Here, the use of imputed rents removes the nasty necessity of having to contend with rising house prices. Other abuses revolve around substitution. If the price of something is rising too quickly, a substitute that is not rising as quickly replaces it in the index. If beef prices are up 20% and pork's up 3%, beef's out, pork's in. And along the same line, anything deemed to be a price spike is immediately adjusted downwards because it's irrational to have a price spike. So I have seen some reasonably sophisticated work on this subject that makes rational adjustments to the published numbers and comes up with an inflation rate in the U.S. closer to 6% per annum, which is dramatically higher than the official rate of 2.5%. When you consider that so many benefits and various forms of income are indexed to the CPI in the U.S., you suddenly realize that the manipulation of the gold price is a rather minor transgression in comparison. Now, If they are going to these lengths to distort the CPI, the fact that gold is being held back should seem like standard practice. What is troublesome to me is the capacity to manipulate the price is so much greater than it was in the era of the London gold pool. Then it was primarily good old central bank sales. I think they dumped in excess of 100 million ounces before they finally coughed it up and decided it wasn't a great idea. But this time around, the clandestine leasing and swapping of central bank gold has greatly aided the suppression of the price. Then there are the gold derivatives. I wouldn't be so presumptuous to expand on this subject after Reg Howe's excellent presentation this afternoon. Reg has forgotten more than I will ever understand about this subject. However, suffice to say, derivatives have been very essential tools this time around in the suppression scheme. However, as was mentioned again earlier today by John Brimelow, because of dwindling supplies of physical gold, the suppression attempt is going to end very badly for them and very well for gold aficionados. Just as in the 70s when central banks couldn't stand the heat and lost the desire to part with any more of their gold, thus triggering the historic upside explosion in the price, the same phenomenon will happen again this cycle. Only it is so much better this time around. Let me enumerate just a few of the reasons why the situation for gold enthusiasts is better this time than it was in the 70s. I mean, first and foremost, and we've talked about this before, the central banks have parted with a far greater quantity of their gold this time than they did the last time, and far more than is generally known. And they've obscured that fact with the bogus accounting endorsed by the IMF. I mean, receivables are not distinguished from gold. This was talked about earlier, but I mean, I think it's really significant that the receivables are not distinguished from gold held in the vault, thereby obscuring how much metal has already been dumped into the market. And the second great point is that there are a number of new influential players on the central bank scene who are not under the hegemony of the U.S. Like it was back in the early 70s, it was a fairly homogenous operation. However, the central banks today, I mean the Far East, China, Russia, etc., they've been accumulating remarkably huge reserves, primarily U.S. dollar denominated. And at some point, I believe they will be delighted to relieve the Western central banks of whatever further gold they feel that they may wish to dispose of. Now, thirdly, back in the 70s, trust me, there were no derivatives or there were no stale short carry trade short positions aligned on the wrong side of the market. And then lastly, there is infinitely more paper this time around depreciating crappy paper money in comparison to the outstanding gold stock than there was in the 70s. So thus, I would say that despite immense frustration on the part of the gold enthusiasts at this time, and I'm certainly falling into that camp, the people with the real problem are the bears. The fact that this is also abundantly clear to me, as I'm clear as it is to many of you in this room, at a time when the vast majority of society could absolutely care less about the subject, is perhaps the most bullish aspect of all. However, I mean, as bullish as I am, I've now got to get a couple other things off my chest here. And despite my total conviction on where the gold price is headed, there's a couple of other edifying issues less edifying issues that I would like to address. Very simply, as a whole, and with notable exceptions, the gold industry is not helping to expose and end the price manipulations. I would dare say that the gold companies as a group tend to be their own worst enemy. It is maddening when the executives of these companies refuse to publicly acknowledge what is happening to the gold price. Andrew and I sent our report, Not Free, Not Fair, to all of them and elicited virtually no response. I suspect that this reticence to face reality may stem from several sources. And this was discussed earlier, but I have to have my 2 cents worth on the subject. I think first and foremost, that most of the major gold companies are managed by professional management teams that tend to be salaried employees, albeit with large bonuses, rather than shareholders. And they view themselves as being part of the establishment, and accordingly, they do not want to rock the boat. Secondly, and I think this is a legitimate concern on their part, and I would not be critical of them on this, they may fear the wrath of big government, which does control the granting of permits and their taxation policy. I think this is an issue, and I sympathize with them in that. And lastly, heaven forbid, they still might be listening to their bullion banks, who beg them on the hedging issue and continue to feed them serious misinformation. Now, I must confess that I feel very disappointed as a shareholder and as a large fund manager in the gold field. I mean, it is disappointing to see the companies that you really like and believe in, and they just won't go there. But the fact that they won't, I don't think we can change it. I mean, it is what it is, and until our view becomes socially acceptable, I don't think we're going to change that many minds in the gold fraternity. But I personally, just as an example, though, I personally know the senior management of one very large gold company who shall remain nameless, obviously. I know them very well, and they know what is going on. I mean, I've talked to them, I've sat with them, and I strongly suspect that they share our view and how this is all going to end. But at the same time, I know that they would view it as terribly impolitic to blow the whistle. And these guys are some of the smartest guys in the business, so if they won't go there, I can understand why the rest of the mopes won't. Now, there's another aspect of the behavior of many gold companies, though, that I find particularly annoying, and that relates to their constant attempts to put themselves in the best possible light in the ongoing battle to attract investor attention. Like, I certainly am not going to advocate that they hide their light under a bushel, but to continually leave the impression with an unsophisticated investing public when it comes to gold that all is well in the industry at $425 gold is absolutely ridiculous. The industry is in a crisis, and production is going to fall in the next 3 or 4 years, irrespective of what gold prices do. The companies talk of glowing growth plans and have always gone to great pains to emphasize their low cash costs. With the odd exception, cash costs are the biggest pile of hooey anyone has ever come up with. Oh, if you want to have a low cash cost, capitalize everything under the sun and ignore sustaining capital. However, for the longest time, everybody was reporting very low cash costs, giving the impression to the great unwashed that everything was just swell. However, if one examined the income statements of most of these companies, there was a disturbing lack of cash generation. Today, I suspect that if you took the average gold mine and fully costed it, provided for a reasonable exploration budget and G&A, and demanded a rate of return commensurate with the considerable risk in mining gold, a $600 per ounce gold price would probably be required in a really hard-nosed evaluation to make this thing feasible. And another problem that no one has wanted to talk about for the longest time, but finally has become so in your face that you can't ignore it, has been the absolute explosion in the costs and capital costs to build new mines. The cost of virtually everything that goes into building a mine has outrun the price of gold to date by a considerable margin. So a lot of the projects that used to be promising are no longer very attractive at current gold prices in particular because of the cost considerations. Now, I may be naive. I don't think I am, but I may be naive. But I honestly think that if our bureaucratic central bankers had any idea of how really unattractive the gold mining business is at these levels, they might not be in such a hurry to unload their dwindling supplies of gold. I mean, it really is an amazing, anyways. Now, this may get a few people's feathers flying, but the other group of gold miners that exasperate me, and this is one of Eric Sprott's and my favorite bête noirs, are the ones who feel compelled to get into production immediately in this environment, irrespective of the cost and the dilution to their existing shareholders. They get terrible financing terms currently, and they seem to be unconcerned about the fact that they will be selling a very valuable commodity for a totally unsatisfactory return. It is a classic case of management worried about its own interests and not about those of shareholders. My only advice to them at this time is Things are going to get better in the not-too-distant future. So continue to develop your resources and reserves and wait for the market to turn in your favor. So not only will you get better financing terms, when you finally dig the stuff out of the ground, you're going to get a lot better price for it. I love companies who are patiently building legitimate assets in the ground, but I must emphasize the word legitimate. Another problem that the industry faces is that there's so much extreme promotion with arm waving about millions and millions of ounces that probably many of them will never be mined. This doesn't help the cause in the sense that people still seem to think that gold mining and there's lots of gold around. Trust me, there isn't. I mean, we've been mining 80 million ounces a year. We're not finding 25. I mean, the life reserve's going down the toilet. Now, having said all of this, now I've got that off my chest, the next few years are going to make up for the aggravation that all of us in this industry have endured for the last decade or 2 decades, depending on how long you've been suffering. The gold price is going to explode. There's no question in my mind. And the companies with real ore bodies are going to prosper. If only more people would have embraced what GATA had unearthed earlier, we wouldn't have gone through this agony, and the whole process would have been speeded up. But it's going to finally happen, in my opinion, soon. And as Bob Landis was saying this afternoon, maybe GATA and the rest of us should be thinking about what we can do to sort of pick up the pieces when this whole thing explodes, because I think the case has been made brilliantly that the gold market has been manipulated, and the outcome is going to be brilliantly in favor of those who like gold. Anyways, thank you very much. You are a great audience. Finally, for the first time I get to speak to an audience and don't look at me like I got 2 heads. And it's been a real pleasure to speak to you.